What's your take on whether things have got a bit too stretched for U.S. equity valuations at the moment?
Well, listen, the S&P 500 up 25%, even more now through today's close. MSCI World pushing in on 20% gain for the year. This feels like a really strong year. But we don't think that it's over. In fact, when we talk to institutions, some of the institutions really started to take down risk and found themselves on the wrong side of this trade, finding themselves underweight. And so we think that there are three important things that are really driving the markets. Earnings continue to come in strong. 80% of the S&P 500 reported, and more than 80% of those gains have beat expectations. We've also had an incredible accommodative Fed. And not too hawkish, not too dovish, putting the policy just right, continuing to support this market and continue to support these gains. And finally, last week's announcements, we had two things. We've got a new COVID pill, and we've got drug manufacturers that can distribute to 11 to 5-year-olds. That's going to drive this transition that we're seeing from buying goods to investing in services and buying services and experiences. We think that these three things are going to continue growing this market, through the end of the year. In fact, our mid-year 2020 price target of 5,000 is only about 6% above where we are today. We think there's some risk that we might see that a little bit earlier. Not saying that we won't set ourselves up for some volatility ahead, but all of those factors mean we continue to expect these equity markets to perform.